Hello, everyone. Here is Gemini AI. So, when a company buys a new building or a fleet of vehicles, what's the actual price tag? You might look at the number on the sales contract, but honestly, that's just the tip of the iceberg. Today, we're going to pull back the curtain and look at all the hidden costs that really tell the full financial story of a company's most important assets. And before we really get into it, I just want to give a quick shout out to Dr. Samir Al-Rishani, who, with some AI support, put together the research for this explainer. Okay, so first things first, let's get on the same page. What are we even talking about when we say property, plant, and equipment? Or, as you'll often hear it, PPE. Yeah, these are the big ticket items, the real workhorses of a company. We're talking about things like a factory and its machinery, a whole fleet of delivery trucks, or the building that houses the corporate headquarters. You can physically touch them, and the really crucial part is that they are used to make money over a long, long time. These aren't things a company buys just to flip for a quick profit. And this, right here, this is the main idea we're going to break down today. The true cost of an asset, the number that actually goes on the company's books, is really a mashup of three different parts. You've got the purchase price, obviously, but then you have to add in every single penny it takes to get that asset ready for its intended use. And, sometimes you even have to factor in what it's going to cost to get rid of it way down the road. So let's start with what seems like the absolute simplest asset, a piece of land. I mean, the cost is just what you paid for the ground, right? How complicated could it be? Well, as you're about to see, even accounting for a simple patch of dirt has some interesting layers to it. Okay, so the official cost of land kicks off with that purchase price, but it definitely doesn't end there. You also have to add in all the closing costs, things like legal fees and title searches. Then you tack on any money you spend getting that land ready for whatever you plan to do with it, like clearing trees or knocking down an old building. And here's a cool little twist. If you can sell any scrap or materials from that old building, you actually get to subtract that money from the total cost. Theory is great, but let's see how this works in the real world. So imagine a company, Chambers Holdings, buys a piece of property for $1.2 million. Sounds straightforward, but there's a catch. It's got this old rundown warehouse sitting right where they want to build their new facility. All right, let's walk through these numbers together. We start with that $1.2 million purchase price. Now, look at that warehouse removal. It cost them $50,000 to tear it down, but they managed to sell $10,000 worth of scrap metal. So the net cost to get rid of it was $40,000. Now, why does that get added to the cost of the land? Because Chambers can't start building, they can't use the land as intended until that old building is gone. It's an absolutely necessary step. Then you add in the $5,000 for legal fees, and suddenly the total cost of that land, the number that goes on the books, is $1,245,000. And boom, this is how it all gets officially logged in the accounting records. The company's land account gets a debit, which just means it's increased by that full $1,245,000. And on the other side, the cash account gets a credit. It's decreased by the exact same amount. The company's financial story now shows the total investment, not just that initial sticker price. Okay, so we've got our land. It's prepped and ready to go. But what about the stuff we actually build on it? This brings up a really important question. What's the difference between the building itself and all the other things we might add, like a parking lot or a fence? And here's the absolute key distinction. Land, in the world of accounting, is considered to last forever. It has an unlimited life, so you don't depreciate it. But things you add to the land, we call them land improvements, like fences, sidewalks, or a new parking lot, they obviously don't last forever. They wear out. Because they have a limited life, they are treated as a totally separate asset, and their costs get spread out as an expense over the years they're expected to be useful. That's what depreciation is all about. And just like we saw with land, a building's cost is way more than just the price tag. It includes every single expense needed to get it ready, whether you're buying it whole or building it from scratch. We're talking architect's fees, those expensive building permits, even the cost of digging the hole for the foundation. It all gets bundled into that one big number for the building asset. All right, time for a quick pop quiz to see if you're following along. Take a look at these 4 options on the screen. Based on everything we've just covered, which one of these would be classified as a land improvement? Just take a second and think it through. If you said B, paving the parking lot, you got it. So why is that? Well, it's a structural addition that has a limited life. It will eventually crack and need to be replaced. Grading the land, removing that old barn, those are costs to get the land itself ready, so they just become part of the land account. And mowing the grass, that's just a regular ongoing maintenance expense, not an improvement.
All right, let's shift gears a bit. We've talked land, we've talked buildings. Now let's take these same ideas and apply them to another huge category: all the machinery, vehicles, and tools that a business uses to get the job done.
And you're probably sensing a theme here, right? It's the exact same logic with equipment. The total cost is way more than the price. It's the price plus all the money you spend to get it to your location and ready to go. So that includes shipping fees, insurance to protect it while it's on the truck, and even the labor costs for putting it together, installing it, and running tests to make sure it works right.
This is such a perfect, simple example of how it works. A pet grooming company buys a van for $32,500. Then they spend another $500 to get their logo painted on the side. That painting cost is capitalized, meaning it's added to the van's value, because it's required to get the asset ready for its intended use as a branded company vehicle. But that $130 oil change, that's just routine maintenance. That's an immediate expense.
And check out this journal entry. It lays it all out perfectly. You can see exactly how the accountants keep everything in its own bucket. The vehicles account goes up by $33,000. That's the price of the van plus the logo. But the maintenance expense is recorded on its own line, and so is the prepaid insurance. It's a fantastic illustration of how different kinds of spending, all for one asset, get treated very, very differently.
Okay, so the asset is bought, it's on the books, it's out there working for the company. The story's over, right? Well, not quite. What about all the money that gets spent on that asset during its life? This is where we have to draw a line between just keeping it running and actually making it better. This is another one of those really crucial distinctions in accounting. Think of it like this. An operating expenditure is like getting an oil change for your car. It's a routine cost just to maintain it and keep it running today. You expense it right away. A capital expenditure, on the other hand, is like replacing the entire engine. It's a major investment that's going to make the car last longer or run way more efficiently. Those costs get capitalized. You actually add them back to the asset's value on the books. So that brings us to this final thought. When you look at something massive, like a skyscraper, where does its cost really end? It isn't a static number that's set in stone on the day of purchase. It's a living figure that grows with every single dollar needed to make it useful, and it can even grow years later with major upgrades. It's just a powerful reminder that in the world of business, the true value of something is almost never just the price on the tag.